My name is Heidi Pickman, for those of you who don't know me, and I am the VP of Programs and Policy for Cameo. And I'm going to share my screen just for a quick minute, and then I will hand it over to Susan. I wanted to, there's a couple things we want to do. First, I want to point everybody to the Zoom and orient everybody on Zoom, just so you know, you should all be muted. If not, I might mute you in case there's background noise. Don't be offended. You do have control. You take your cursor from the screen to the bottom of the screen. You'll find the Zoom menu, and there'll be a mic icon on the left. You also see a chat box. You should feel free to type questions and comments into the chat. We will be monitoring them. The chat box is the little blurb that cartoons, the little icon of a blurb that people's thoughts are and speeches in cartoons. So you know we are recording, as Susan did mention at the top of the hour, and you are free to share. We believe sharing is caring, especially in this time of COVID, and we'll make sure we send everybody a link. You'll get a link to our website, which will have the webinar, any other background materials that we have, including the slides. Just a quick thing on the agenda. It looks like we're probably have too many people for live introductions. If you just want to chat your name and your org into the chat box, I'm not going to read them out, but feel free to do so everybody else can see who is on the call. We can see from where you're at. The other thing to do is you can rename yourself with your name and your org on the Zoom. If you hover over your name where it is now, there's 3 little dots, and you can type whatever you want there. I do want to give everybody an update on the sorry about that. The PPP, the Payment Protection Program. I'm not sure if that's the right PPPs, but we'll get to that in a second. Give them an update. That's the $350 billion that came out from the CARES Act last week. They've issued today some guidance on that. So I'll just give you a brief update and give you some resources that you can click on, and we'll include those in the email as well, that you can click on to get some more information. Want to let you know about our upcoming pieces, and I'll also pop these into chat once I stop talking. Alternatives to traditional loans, that's happening on Wednesday, tomorrow. We have a Bringing Your TA online class that starts on Thursday. That class is full, but if you are interested, please email me. I'll pop my email in there. And we're also, I don't have anything set up for this yet, but we're getting together a call on this new program on Friday at 2 p.m. And I was right, the Paycheck Protection Program, it is live. Although I did click on the application earlier today, and it's now giving me a 404 error. So that is a little bit, I'm guessing they're hanging on to it for a couple days. I think they might have published it by accident. Small businesses and nonprofits are eligible. Okay, so everybody on this call, if you are eligible, it's up to, I think, 2.5 times your payroll. And the loans can be used for payroll, rent, utilities. If you use it for those purposes and keep employees on for 8 weeks, your loan will be forgiven in 8 weeks. So I will pop some links in the chat, but for now I am gonna hand it over to Susan, because it looks like we've got people logging on left and right, and get right to the topic of the day, is creating a sustainable deferment loan policy.
Okay, thanks, Heidi. I'll let you take over the chat box and admitting people Welcome everyone. I'm Susan Brown. I've been working with Cameo for a while on microlending development. And we have Catherine Howard, or Kat Howard, from Community Vision to be our main speaker today. I'm going to share my screen in just a minute. We have a PowerPoint slide and a few other handouts to share with you, which we'll also make available. Most of the ideas came right out of Kat's head yesterday. She did a quick download and we created this webinar on the run. But I also attended OFN's Deferment webinar today and added what I thought were the best parts of that. So it's a little bit of both. Okay, so let me go ahead and share my screen. Okay, here we go. So here we go. Let me just get set up. Sustainable loan deferment policy in these fast-moving times. So as I said, I'm Susan Brown, and we have Catherine Howard, Senior VP of Programs from Community Vision. I stuffed everything we're going to talk about into the agenda slide today, so you see a lot of bullets there. It's more wordy and kind of jam-packed than normal on this PowerPoint, but I feel like you'll be able to take these slides and kind of use them as a guide for you and the rest of your organization on how to, respond to these times. So let's go ahead and get started. And Kat, I hope you're unmuted, and maybe you can just go ahead and start, because these are your words right here.
Thank you, Susan. I appreciate it. And I just want to give Susan a shout out. We got on the phone yesterday and went through this, and then she produced an amazing amount of slides. So I really appreciate that. Thanks everybody. Just very briefly, Kat Howard, SVP of Programs at Community Vision. Some of you may know us by our former name, Northern California Community Loan Fund. We are a CDFI based in San Francisco with offices in Oakland and in Fresno. We've been around since 1987. We have about a $78 million loan fund, a little over, about 110 loans, about 90 borrowers. We are a generalist fund, so we do everything from affordable housing, community facilities, and some small business lending. So I'm going to be coming from that perspective and kind of talk a little bit about our experience with what's going on now. It is informed by, I worked at NCCLF during the 2008-2010 crisis, and so some of the work has been informed by the work that we did then, and just walk you through a little bit of how we've been approaching what's been a really difficult time for a lot of our clients, friends, communities, organizations, and thinking about how to think about deferments in a way that's both helpful to your borrowers and clients and sustainable for your organization. So that gets me right to the top, which is to first, the way we approach this, and I'm really going to speak from our experience, and you can take from that as what's applicable to you. But what I think one of the first most important things that you need to do is to establish what your goal is. And for us at Community Vision, it is to really think about being both responsive to our borrowers and assuring that our CDFI is sustainable. We have been around since the 80s. We consider ourselves, as well as all of the organizations that we work with, to be a community asset. It is important to us, not from a perspective of our jobs or our track record. Truly what's important is the ability to have capital flowing into underserved communities that have seen systemic discrimination, and that is our mission, and that continues. And so when we are thinking about deferments and payment holidays and things like that, and workouts, we always keep those two things in mind. And sometimes, just to be really clear, that can sometimes force hard conversations and hard decisions. But if you sort of know what your North Star is from the get-go, you can sort of ground what decisions you have to make in that. So for us, there's kind of two ways of thinking about when a crisis hits, how you want to work with your borrowers. There are a lot of organizations that I have seen that have issued blanket deferments. I think that is certainly a reasonable and appropriate way if you have the capital, particularly if you are working with borrowers that have a pretty similar profile in terms of how whatever emergency, in this particular case, the COVID situation might hit them. For us, we really said, we are not going to be doing sort of blanket deferrals for our whole portfolio because not all borrowers are affected the same. And I think that's something for, for all folks to really think about is that the case? In our portfolio, some of our borrowers really don't have any new revenue, right? And so those are the folks that we're going to be having to look at immediately. But at the same time, we have some borrowers that are unaffected or, may in the long term or actually in the short term and then in the longer term may see an increase in revenue. And when you are thinking back again about this balancing between borrowers and assuring your fund's sustainability, being able to hone into the idea that there might be some borrowers that are, for better or for worse, or better for them, are perfectly fine and able to continue to make their payments, allows you to think about sustainability on your cash flow. And so that's been really important for us. We can go to the next slide.
Okay, and I'll just add that on today's OFN call, it was interesting. One of the organizations presenting the Progress Fund said 90% of their portfolio is in tourism. You can imagine that they are offering some across the board deferrals because tourism is probably close to zero, whereas Justine Peterson shared their portfolio and had a much broader industry mix, so they could probably take a more nuanced approach to their deferment policy.
Yeah, and I think that's really important, right, is to understand what the profile of your borrowers looks like. So understanding that then allows you to go into sort of risk rating of the portfolio. And the way we've approached this in both this last couple of weeks as well as a decade ago is to really do a very quick reviewing of each of your loan and giving yourself a framework in which to do that, to think about a very quick risk rating. And I think we talk about this later, we do risk rating on a regular basis as part of our portfolio monitoring. I'm going to assume many of you do the same. But that can inform this, but you need to really kind of take into consideration what's the existing on the ground situation and how can we think about a quick risk rating in light of it. So for us, what we did is we just said, 3 tiers: high, medium, and low. High, adversely affected within 3 months. Basically, their cash flow has stopped. And we assumed that we made some assumptions around what that would look like, right? So we said, anybody that's sort of a small business that's customer revenue dependent, that's probably going to be the case. And I want to point this out as an example because of something else that happens later, but we assumed actually we have a whole portfolio of fisheries. We run the California Fisheries Fund, so a whole portfolio of commercial fishermen. We actually assumed that they were going to be adversely affected. And then we knew that, through our quick risk rating that some of our folks were going to be more of a medium. So in the short term, they, had pretty strong cash balances. They would be able to continue to do some of their work, but they would probably be affected if this was going to go on with, for any sort of longer term than 3 months to a year. And then low was the folks that we went, yep, this, they're really not going to have a challenge for one reason or another. Their revenue is going to look the same. They have good reserves, whatever that might look like. And so we can, we certainly want to talk to them at some point, but we can kind of put them over off to the side and say, they're going to be unaffected or growing. That's who we don't really need to concentrate on right now. So, calling your borrower is the best thing you can do in terms of checking your risk rating assumptions, right? Is to actually have those in-depth conversations. It's helpful for you to do that original sorting because it really gives you a way to structure who you're going to reach out to and why. And then have an understanding of what's their current and near-term revenue streams. Now, I think in every lender is going to have a sort of a mixed experience with this. Some of our borrowers, we know our borrowers well, sort of immediately reached out to us. So we knew the ones that were really sort of in a panic, but then we wanted to call everybody on that high list first. It also allows you to kind of just, reality check your assumptions. So for example, in our fisheries fund, which we assumed everybody was just going to be high risk, turns out that the fishermen that were working and selling predominantly to international markets, mostly of the Pacific Rim, they were having a lot of problems because their markets had shut down. fishermen that we're mostly selling here locally. You know, as you all have seen, if you're going to the grocery store, there's a real demand for fresh food. And they have actually been able to sell pretty well and weren't having as many revenue challenges as we thought. So being able to reality check that sorting is really important. And then, you know, you should start thinking about like what is going to be feasible for folks, right? If you're talking to challenged borrowers, are they truly just no revenue? Is there a way for them to pay interest only? Can they make, you know, a partial payment, a full payment? What could that look like? And then risk, you know, adjust your risk buckets on a regular basis. We didn't talk about this yesterday, but Susan, I see put staff huddle and debrief once a day. We are definitely doing that. Our lending team is doing that. Our lending team consists of both loan originators and then people in credit and loan administration. We're talking on a daily, sometimes multiple daily basis. And then we're talking again to our board, at least the executive committee, and frequently the full board on a weekly basis to give them an update.
So Kat, some of these are your ideas and some came from the OFN call today. I heard a lot of different things thrown around, so I just threw them all onto the slide there.
And I think I can actually probably, I didn't get to go to the OFN, but I can talk a lot through all of this.
Yeah, please.
So, you know, deferment structures, right? And these are pretty straightforward. So there's the blanket 90-day deferment for all, just don't pay us for 90 days and then we'll come back and talk to you. And, you know, we'll set a time period where we're going to talk to you in 60 or 70 days and see what's going on. There's a, you know, deferment on P&I when you're requesting it, or just interest only after that. There's 30-day pay waivers. There's, you know, you can go to month. You know, I think it's interesting, the idea that waiving payments but keeping the ACH active with $10 a month because there's continuity and financial connection. I think that's a pretty good point. So really, I guess the point being here that there's not going to be one size fits all, right? And unless you have a portfolio of very similar borrowers where you have an expectation that not only are their reserves the same, but their revenue streams are the same, and their net revenue kind of looks the same, you're really going to need to be able to think about like what is going to best suit both your borrower and your organization. And if there's a way to get a little bit of a payment stream, then go ahead and do that. And if there's not, be prepared to think about, you know, making sure that your borrowers can get through this in some way. What you don't want to do is being, you know, sort of bridging to nowhere, like, well, you know, this borrower is almost assuredly going to go out of business in 60 days and, you know, and we're kind of bridging to nowhere. So really kind of think about like, what is the scenario planning? How do you work with the borrower around that scenario planning? For those of you that do ACH payments, you know, one of the first things that we did is we just called off all the ACHs immediately. So we have developed a tool internally. It's just a Google sheet where we have every borrower, we have, you know, what their payment is, what their principal, what their interest, if we have a participant, what's coming into us, what's coming into the participant, and then how they pay their loan, and if it's ACH or if it's check. And then what we instructed our accounting team was, do not initiate any ACHs. Every ACH has to be approved by somebody, that going forward has to be approved by somebody in our lending team that's talked to the borrower, so that we're all very clear that the ACH is about to happen. One of the things that we have also been talking about, and we may talk a little bit more about this going forward with the state guarantees, I can talk about it now actually, is that in certain cases, you may want to defer payments early, but you may have borrowers that in certain situations that actually have to keep making interest payments. And so in our case, we have a number of loans that have state loan guarantees, and we'll talk about this in the next slide. So this California Small Business Loan Guarantee Program. And part of keeping current with that program is even if you defer payments, that interest payments still have to be made. And so what we have been thinking about for our hardest hits clients is how do we effectively set up an interest reserve for them? So we're going to give them some additional money. We will be holding it in-house. And then we will be making those interest payments through that interest reserve. And then what we will be doing is we're making effectively a B note So we are holding that as a separate loan, and then working out what the repayment of that will look like. Either that'll, once they start making regular payments because their revenue sources are back in full, then they might pay it over a course of a number of months in equal installments. We may choose to defer it to the end of the term of the loan. It's really going to be based on the individual situation for the individual borrowers.
Right. And so what you see on this slide are some ideas about what to do now with people who can't make full payments. And then 5 and 6 are really like, how do you catch up? How do you structure the catch up towards at the back end, once assuming people are businesses are back on their feet, and there's some options there.
Yeah, and I think really what's important is knowing what your borrower's revenue stream is going to look like. And I also would say, even if you think they're going to be bouncing back well, to give them enough of a grace period in doing that. If they decide, yes, we don't want to tack this all on at the end because we don't want a bigger balloon payment, we'd rather up our payments on a monthly basis, really give time for that. I mean, we're going to be likely going into recession, right? It's just going to be unknown. So give there a lot of leeway as to when that can start. Okay, so I made reference to this. So one of the things that I think is really important, and we will talk a little bit about capital sources in general, but is to just really understand the profile of, one, how you have funded your loans, and then 2, what the back end of it looks like, whether that is you have a participant, so you are servicing the loan, but you've sold a portion of it off, or you've guaranteed it with a credit enhancement program of some sort. You know, there's lots of different credit enhancements out there. We actually run one for food businesses called Freshworks, but we also use the California, as I mentioned, Small Business Loan Guarantee Program a lot. And so it's been really important for us, as we've been doing our sorting and thinking about deferrals, to prioritize our loans that have the state guarantee because of important things around that program, which is that you can only do one deferment, and it's for a maximum of 6 months, and that the borrower has to be current. And then you can only extend for 7 years. And so because the borrower has to be current, it was really important for us to jump on those organizations that had, for those loans that had state loan guarantee first, so that we could defer while they were current, rather than waiting 30 or 60 days or 45 days or what have you. The borrower is no longer current. They're no longer then eligible for deferment under the guarantee program. So that's an example. But I think what's really key is understanding the caveats of those individual credit enhancement programs that you're working with. And if you need to prioritize within those, prioritize. Similarly, understanding your capital sources. So, you know, we don't match sources, so our individual loans aren't being funded by a specific source. There certainly are CDFIs that do that. It is a perfectly reasonable capital structure, capitalization structure. We happen to have a blind pool, so everybody invests in us, and we then put the loans out. However, you know, if you are in a position where you are doing funding match, make sure that you have an understanding of what those capital sources look like, and if you have to do anything specific around your loans. So first and foremost. Then, you know, in a larger kind of more global sense of thinking about your organization, what you want to consider is how can you manage to not just what you're doing on the borrower end in terms of deferments, but what that looks like for your cash flow, and what that looks like in terms of what you might want to do in terms of asking your capital sources. So I'll walk you through our example. We are a blind pool. We have, you know, 200 plus investors. We have individual investors. We have religious organizations. We have a number of institutional investors. We have some government investors, among others. With our large capital sources, most of those are institutional investments. We have not yet, but we are taking a look at and considering the opportunities and options around asking for a deferral of our payments of interest to those sources, with the understanding that we are doing that because it is allowing us in turn to defer payment from our borrowers, right? One of the first things that we then have been doing, however, is making sure that we can do that under all of our agreements. So we know that we can defer payments from our borrowers because that's built into all of our standard investor agreements. What we want to make sure before we go out and ask for any deferrals of our payments of interest to our investors is that we're not going to cross default somehow, that one of our investor agreements doesn't say that if we become non-current, even in an agreed non-current situation, that we, with one investor, that cross defaults us with another investor. So we've been really thinking a lot about that. We've also wanted to say, you know, we don't want to just go to investors and just blanket say, hey, can you defer, right? Because that's not really the most compelling of conversations, but to really have a chance to do all our sorting with our loans, understand who we're deferring for, understanding what that means in terms of our cash flow, and then being able to have a pretty cogent argument around, here's what our cash flow looks like, this is what our revenue has changed, and this is why we are asking you for, you know, either the deferment or easing restrictions on covenants or whatever it is that you might be asking your investors. The other thing I'll say that we have done, and we're sort of lucky, well, we're not lucky, we have been conservative as an organization, and thus we are lucky to be in a position of having cash reserves. But we have quarterly payments that are due right now, and we are choosing to make all of those payments to our investors rather than trying to defer any of them. We think of it as a good faith showing to them that we are not just saying, gosh, we're really sorry, you know, bad situation, we don't want to pay you, and that it will give us a little bit of a negotiating opportunity going forward if they know that we've been in a position of making good faith payments when we could. You know, so really all of those things are the building blocks of you putting together a really strategic ask from your investors when the time is right to do that, when you have an understanding of what your cash flow looks like. You know, I'm going to, Susan, I'm going to throw it over to you for this final point around accepting the equity.
Right, right. So this last bullet came from the OFN webinar today, where one of the presenters said they again, just like Kat's organization, had lived through the last recession, and they made sure that when they accepted equity, they, you know, that often has a balloon payment, that they have staggered payments so that they never get hit with having to repay too much at one time. So that if that's not a strategy you've already set up in your capitalization plan, that's one to think about, especially for times like this. And I think we have a question. Sarah from Working Solutions, can you unmute yourself and ask your question, Sarah?
Thank you. I think I'm unmuted. Can you hear me okay?
Yes, yes, we can hear you, Sarah. Go ahead.
All right. Hi, Catherine. Hi, Susan. Thank you guys for hosting this. And this sounds like a lot of great thinking, Catherine. Thank you for walking us through it. I know the slides will be available later, but I just wanted to make sure I heard correctly the idea around interest payments covered by the CDFI as a note, was it?
Yeah,
we have a slide on that, so we'll.
Okay, so we'll go into it a little further. But yeah, happy to talk through it.
Thank you.
Sure. And I'll just say on this final point, you know, I think it's just a great business practice in terms of staggering those repayment schedules to your investors. I mean, one of the things that and I think there's two things: staggering repayments, and then over time, really tracking what your renewal rate is. You know, so if we're an organization that's been around since the 80s, we have some investors that have been with us since the 80s. And so we have a pretty good knowledge that even if those investments are going to mature, that they're probably going to roll over. And, you know, you can't always assume that, but it's a pretty helpful, you know, kind of understanding of your portfolio to if you have an understanding of what your renewal rate looks like. All right, operational reserves. So this is something that clearly gets built over time, right? We have been in a position where our longtime leader, Mary Rogier, was very thoughtful around operational reserves and wanting to be a well-reserved organization because we are stewarding other folks' money, and our CFOs over the years have been really in line with that. So We have a, over 6 months operational reserve. We really, when we got to the recession, we were like, yep, that's absolutely a best practice. We keep it in place. That is in addition to our loan loss reserve. And I know we'll talk a little bit about loan loss, so I won't get into how we go through that now. But it does, we are sitting in a position where we don't know quite yet, but I suspect that our revenue off of interest is going to go down fairly significantly over the next several months, and that's going to be a 25 to 50% hit if I was going to give you kind of the round numbers before we finalize them. And so being able to have that healthy, both operational reserve and loan loss reserve, just allows you the space to be able to do the work that you need to do. So, for us, we're not doing any layoffs. We're keeping everybody in place. We're in fact continuing to do a hire or two because we just need the capacity, because we know that we have that to fall back on. Absolutely understand that is not everybody's situation, particularly if you are a relatively new organization. We've built those over time through what we have done has been very careful around operating, net revenue and putting it aside as reserves over time. But I also think that the idea of being very thoughtful about your loan loss reserves, sometimes they're a real pain, like when you're in good times and you're like, why are we holding this many reserves on our balance sheet? But it's for just these kinds of situations that you're thoughtful about loan loss reserves.
Yes, and we have a slide coming up on loan loss reserves. And one reason I put some of these slides in here is not that sometimes these are things you can do now, but I'm hoping this slide deck becomes a little bit of a boilerplate for how to weather a recession and can be used also for planning in the future. And we have a slide somewhere in here about loan loss reserves.
Yeah.
And here's our subordinated notes slide.
Yeah. So Sarah, this speaks to your point. So because we're a construction lender, we frequently do interest reserves, which is you are making a loan of $100,000, but you know that there won't be cash flow coming off the project, frequently in construction, for several months. So you capitalize the interest that would be paid during those months and set aside in it's sort of a separate reserve account. It is all part of the note. And then you pay yourself, right? You move the money from like the $1,000 a month for 10 months. If you want to have a $10,000 reserve in this example, every month you pay yourself that $1,000, and it gets added to the balance of the loan. In this case, we're applying that concept to a few of our borrowers who are really impacted, who can't pay interest at all, but are on our loans that are guaranteed by the state loan guarantee program. So what we're doing is effectively advancing them additional capital beyond what we originally did from their original approved note, and saying, okay, over the course of the next 3 months, we're taking it 3 months at a time right now. We know your interest payments are going to be X, let's say, $5,000. So we are creating a separate note to that. We could also amend the note, I suppose, but we're effectively kind of creating a separate note so that we can have separate payment terms on it. And then we are paying ourselves in place of that, so that we keep that loan current with the interest payments, because it's in our best interest to continue to have that state loan guarantee in place, and it would go away if those interest payments weren't being made. This is also a way that you can just capitalize, you can capitalize interest payments if you want to do it that way. We aren't doing it for a large portion of our portfolio. If we were going to have folks that are deferring, we would just probably, just defer it and figure out that we were tacking on to the back or what have you. But in the case of something where we are truly like making the payments for ourselves, then we're creating a subordinated note and moving that forward. And You know, it's kind of a temporary measure. You can't do it indefinitely. You know, at some point you can't keep paying yourself for your own loan. But until we kind of get to a place where we have a long-term understanding of what's going to be going on and what our borrower can do, that's our strategy. And then the idea being, why are we not just tacking it onto the existing loan? Twofold. One, the loan has you know, we've already agreed on a loan. That loan amount is what's been guaranteed by the state loan guarantee program. But secondly, that gives us some flexibility around how our borrowers choose to work with us to make the payments for that eventually, whether that is choosing to break it up over a period of time and saying like, okay, we're going to start resuming our regular loan payments, plus we want to, you know, pay off 1/12 of that note for every month for the next year, or we're going to pay it at the end of the term, and that's really going to be determined based on what the individual situation for each borrower.
So this allows you're taking on the expense of those interest payments as a community vision expense for now, and then you'll see how to resolve it in the future.
Yeah, effectively that's the case. And you know, when you're paying yourself, it's a non-cash expense, which is nice, right? So we aren't actually putting cash out the door. It's moving it from column A to column B, but nonetheless, we are taking that expense upon ourselves. We're paying ourselves. And yeah, and I'm happy to answer further questions about it. Okay, so documenting deferrals. I know that this morning on the OFN call, there were some documents that were shared. So Susan, I don't know if you got a hold of them, and I'm sure we can share them widely, you know, and make them available. One of my colleagues downloaded them. I haven't had a chance to look at them, but telling you just a little bit about what we have been doing. If we are not doing something where we're creating the second note, we can defer and create an amendment to the note. We're working with our lawyers on what that looks like. We may end up eventually restructuring to extend the maturities, or, you know, make partial pay downs. You know, there may be some things that we choose to do in there. But yeah, it's really important to, one, to the extent that you have legal counsel, talk to legal counsel, figure out the quickest, cleanest, and easiest way to do it, because, you know, particularly if you're going to have to do these, several of them over a short period of time, you don't want to have to be producing large amounts of docs, which is why an amendment is certainly an easy structure to go for. And then absolutely what's right here is make very clear, you know, if you are forgiving them the payment, then by all means, if you're able to do that, by all means, make that clear. If you are not, very clearly document in your language that there's promise to pay language, that is deferment of the payment, that the payment is due at some, you know, whatever point that agreement is, not that you are foregoing it or forgiving it. So that's you know, ideally you can have counsel who's working with you on that to make that clear. One of the things that we have done is internally, so we're not a volume shop, which means that we end up doing these credit memos for our regular, you know, lending that are like 25+ pages. You know, some of you may feel me on the like extended credit memo situation. We know that's just not possible right now. So what we have done is we've created a deferment term sheet that explains exactly what we're doing in terms of our deferment. And we can provide that, you know, to our borrowers, and then we've made a template on a deferment memo, so that it is no more than a page and a half, maybe at the very most, where it is very clearly like, this is who it is, this is the loan numbers, this is what the outstanding balance is, this is what the maturity is, this is what we're doing. We're, you know, deferring principal, yes or no, we're deferring interest, yes or no, we're creating a reporting requirement. We are suggesting internally for us that reporting requirements are pretty minimal. You know, if we're doing these, you can see an example of what we're doing here. If we're doing a 3-month deferment, we are definitely requiring a check-in at the end of month 2, so we understand, are we able to start redoing payments, or are you going to need additional deferment? We, in certain cases, are going to ask for, you know, a monthly cash statement, just so that we understand what's going on with the borrowers. The last thing that we want to do is to find out sort of after the fact that they went through their cash and, you know, and are going to cease to exist. And then it's very simple, like impact of the COVID crisis, give me 3 sentences. Like their revenue has gone from, gone down 50% from X to Y. What's their liquidity? You can see here all the ratios that, well, not all the ratios, but a couple of the ratios that our system kicks out. So we can, put our financials in and it kicks out of the system. But basically, like, what's their burn rate and what's their liabilities and what's their cash? And then what's their strategy for maintaining the organization going forward? And those are the basic 3 things that you need to know. What's the impact? What do they have to fall back on? Who's in charge and what are they doing? And then, make your decision and make it really quite quick. I thought it was, there was another pretty interesting OFN webinar last week.
One? Oh, sorry, go ahead.
Oh, no, it was last week. And the folks at Renaissance Enterprise in New York were saying that they have in the past, and they've done things with response to Sandy and response to 9/11. They're a full, just only small business lender. They very quickly do kind of a lean search to understand if there's a lot of other debt for their borrowers too, because that may impact them. That is not as much of an issue for us, but certainly I think a reasonable idea in this situation where they're, lean searches may or may not be something that you're able to actually access, depending on if that's essential personnel or not. But having that conversation about like what's your full debt load, I think is a helpful one.
Yeah, and this is another document that was shared, I think, at an OFN webinar today, restructure renewal process. So Kat's organization, Community Vision, has been willing to share their deferment memo and term sheet, so we can make that available to everyone.
Yeah.
Are we good for the next slide?
Yeah.
Okay.
So on loan loss reserves, so I'll just walk you through a little bit about our process, and then what we're thinking about in terms of loan loss reserves right now and then going forward. So we do a monthly, not monthly, excuse me, a quarterly loan monitoring and risk rating meeting where and this was a lot easier when we had a smaller portfolio, and we're changing it a little bit now. But historically, what we have done is we've looked at every loan, and we have a system that's set up about what we look at, which is basically what's the collateral, what's the cash flow, what's the performance been, and who's in charge, and how is that team maintaining. But we do that on a quarterly basis, and then we risk rate each loan, and then we have a set aside for our loan loss reserve based on the risk rating of each loan. We then compile that and then turn that into our quarterly adjustment to our risk rating. So if it goes up for some reason, we expense it, through our P&L, and then it sits on the balance sheet. If it goes down for some reason, that's great. We can, take some of that risk rating off the balance sheet and put it back. But in either case, we do that regularly. And so we have a pretty good understanding of our borrowers on a quarterly basis. We're also relatively conservative. So right now, as of our last risk rating, which was just a few weeks ago, our loan monitoring, we have a 8%. We have an 8% loan loss reserve, and that's in part because we do have one loan that before all of this we were doing some workout, so we had over reserved for that loan. I will then tell you we have a historic loss rate of right around 1, so you understand that that's relatively conservative. And so we right now have not made a choice to increase our loan loss reserve at all under the current circumstances. We think it's just too early. We just really don't know. We don't have any idea of even the folks that are in our kind of high, like their revenue has gone away. We don't have a good enough understanding of like, does that mean that they are all going to go out of business? Does that mean some of them are going to go out of business? Does that mean that there's opportunity for them to come back slowly? For us to make a change. But that is in part because we felt, like we were relatively well reserved to begin with. a couple of things on that. As we get additional information, we are not only going to now change this reserve quarterly. Like, so if we get more information and it is really definitive around our borrowers, we can choose to increase our loan loss reserve, and we will do that if we need to. And we take very seriously the idea that we expense it through our P&L and it sits on the balance sheet and it is truly a cash reserve. That is one of the things that can give all of our investors, confidence in their ability to get their investments back from us.
Okay, so a couple things. One, we have a question from Jesse. So Jesse, go ahead and unmute yourself. And I'm just keeping track of the time. We have technically 15 minutes left and 7 more slides.
Okay.
I think we're all willing to stay on and not only finish the presentation, but stay on for questions. Are you able to do that, Kat?
I am.
Okay, great. So this may go over. I hope you guys can stay with us. So Jesse, go ahead and ask your question.
Okay, can you hear me?
Yes,
Yeah.
I can.
Oh, good. Yeah, I was wondering if we have done a couple of deferrals already,
Yeah,
without establishing this process, could we, or should we go back and let the person know, hey, we developed a policy and we're asking you to work with us on that?
I mean, it's a good question. It depends on how you did the deferral. You know, if it's just your internal processes changing, I don't see any reason why you would need to do that. If you feel like you've documented it in a way that you're now feeling a little bit more uncomfortable with, you might want to go back to them and say like, hey, you know, we were trying to work with you really quickly. You know, here's where our areas of concern are. We'd just like to revisit this. You know, I mean, some folks have deferred almost immediately because they knew they had to. And we kind of got this process going real quick just because we had gone through 2008 before. And so we knew that we had to do that. You know, I think it really just depends. If you want to establish some additional processes internally, but you know you ultimately were going to defer these loans anyway, I wouldn't worry about it so much. If it's more of a documenting thing, then go back and have the conversation.
Okay, thank you. That's a good answer.
Yeah. Okay, so deferment approval authority. This again goes organization by organization on who approves your loans. So in our organization, we make loans up to $3.5 million. And so we have a multitude of loan approval levels. So there's a level that our chief credit officer can approve. There's a level that myself and our president can approve. We have an internal loan committee that's another step up, and then we go to our loan committee, and then anything that's non-conforming to our policies or above $3.5 million has to go to our board. In the case of our adjustments to our loans, we have chosen to say to our board and loan committee that we wanted to be able to do staff level authority, not because we want to take it out of their hands, but that, you know, that we wanted them to give us the authorization to do this, but really around expediency. So, you know, our loan committee meets once a month. You know, what the alternative is to say, basically, you guys have to meet ad hoc all the time. Our board now the executive committee of our board at least is meeting once a week, but even then, sometimes like we want to just be able to push things through and forward. And so we've had those conversations, and we're getting a formal approval of this tomorrow, I believe, you know, but we've already been kind of in the process of doing it. And really what has been key to this is two things. One, we have, you know, lending staff that have sort of established track records with our board. So the board has a lot of confidence, and we communicate a lot with them. And so part of the agreement with this is, you know, we're going to be able to have deferral authority, but we're then immediately going to update you on it. So it's not going to be like something that you find out a month later or 2 months later. They also, you know, one of the first things that we did once we finished going through our portfolio on the high, medium, and low is I did a pretty extended report out to our entire board so that they're really well informed about the portfolio, so that they had an understanding of the scope in which of, that we're not doing this for the whole portfolio, that it's probably going to be a universe that more looks like, X percentage of it, so that they could get a sense of that. And they could, and get comfortable that we would be making those decisions. So, again, your mileage may vary. It really depends on how you make decisions to begin with around your credit authority. What I would just counsel is to balance the sort of three important things of communications, trust, and trust building. Because this is a trust building process with our board as well. If we're going to be making these decisions, we want them to trust that we are making good ones. And we did that last time we had a recession too, which is another reason why they are comfortable with us moving forward. But that combination of expediency, making thoughtful but expedient decisions, trust building, and communications.
And I think I'd like to say that I've worked closely with some of the CDFIs in our network, and some CDFIs are newer than Community Vision. Some have maybe newer staff, less experienced staff. Some maybe have gotten into trouble and therefore kind of rebuilding or have a weak portfolio. You really have to judge this approval authority based on the reality of your situation.
Yeah.
And while you want to act quickly, if you don't have the bandwidth that's being demonstrated here, you may have to move a little more slowly or get more people in on some of this deferment discussions in order to be prudent and not and continue to protect yourself and your borrowers.
Yeah, that's a really good point. I really expediency for expediency's sake without thoughtfulness behind it can get a lender in trouble pretty quickly.
Okay, next slide. Strategic requests to investors.
Yeah, so I talked a little bit about this when I was talking about sort of the cash flow and the idea of thinking about talking to our investors around potential deferments for ourselves. As I mentioned, we're waiting. We want to really have a better understanding of what our situation looks like, and so that we can have a pretty strategic conversation. With that said, we have chosen to have a temperature check call with a few of them, particularly some of our larger investors. We talk with our largest philanthropic investor, which is also a partner on many of our programs. They're folks that we trust quite a bit, and they have a lot of trust in us. So we felt like we could have an early stage conversation with them and say, want to be really clear, we're not saying we're doing this. We're not saying where there's a problem. What we're saying is we are trying to actively figure out what this looks like. And what would be your response?
I'm on a phone conference.
I think we've got
Jesse,
somebody.
can you
Yep.
mute yourself, Jesse? Or
Oh, I'm sorry.
yeah, just mute yourself. Thank you.
So those have been really invaluable. We've done that with both couple of philanthropies, and then we've had a couple of bank institutional calls where we've said that, and it's really been couched in, this is truly just wanting to know what your strategy is going to look like. And our investor base has been pretty receptive, and it's again small scale, small sampling, but pretty uniformly has been like, hey, tell us what you need. We're in this together. We know that you're going to have to be making deferments. So we're okay with it. The other thing I would say, and this on here, is it's not just about deferring your interest payments to your investors. There's a few other things you should be thinking about. One of those is potentially if you have covenants that you think you're going to need to change, whether that's around leverage or anything else with your investors, think strategically around those so that you can address those. And then if you need additional capital for a variety of reasons, that can be capitalizing a new fund so that you can get, low cost money out the door. We've had a couple of impact investor conversations where we've said, like, look, we really want to put 0% money on the street. We have a cost of funds right now. But if you could give us 0% money, and particularly if you could, mind that up with like just a little bit of operating support, because we're going to be losing, net revenue right now. We want to get that out there. And so, is there a possibility of doing that? What my impression has been is that funders right now are very rightly so, not necessarily looking at immediately looking at capital needs around intermediaries. They are much more focused in their first wave, whether you're looking at the community foundations or the private foundations, around getting money to folks that are doing, really on the ground response work, whether that's health or food access or, homeless services or what have you. That is well positioned and absolutely the right priorities. Most of them have also said, whether, publicly or in conversation, we fully expect and intend that there's going to be a second wave. And that money, that's where we want to get some feedback from you. And so to the extent that you can just say, I just love to give you a feedback conversation, like I know that you're not there yet, but this is the kind of stuff that we're going to see that we're going to be needing. We also are going to have a revenue interruption, or we really need to capitalize a 0% loan pool, or, we need to deferment because we're deferring our payments. Whatever that conversation that's important to you, start putting it out there now about like, let us know when the right time is. Can we give you feedback? We'd like to be able to help influence your what you're crafting for your second wave.
So I added this, Kat, because it did come up on the OFN call today that,
Yep.
Again, we're all sheltering in place. Organizations have different capacity for virtual service delivery, document, creation and signing, all that kind of thing. So I think this is one of those times where if you haven't thought about your virtual capacity, it's probably good to think about it now and to build it in the future. Certainly around document signing, if we're talking about deferrals, we're talking about, even if you're just doing amendments to notes, things are going to get signed and passed back and forth. You want to, of course, have virtual meetings and online coaching capacity. And Cameo does have an end-to-end lending platform program lending front that can keep you fully operational in a shelter-in-place environment. So again, this may be something you do partially now, but build into, we have a slide here about building a deferment, emergency economic downturn policy into your loan manual. And this might be one of the strategic elements you need to include for future, problems we have.
Absolutely second all of that. And we're going to talk a little bit about like deferment policy in the loan manual, but other things I would say, these situations always show you where your sort of pressure points are. We've been dealing, as kind of larger as we are, we've been dealing with the same thing. Like, oh, does everybody have DocuSign? Okay, we need to make sure we can do that. And what are the authorities around that? And having those things really clearly spelled out just makes your life easier when you're having to think about a lot of other stuff. This is a great idea to have a deferment policy in your loan manual. What we did is we actually had guidelines that we had in place last downturn a decade ago, and that was both about like underwriting going forward with new lending, and some around what are we doing in terms of portfolio management. So while we didn't have them in place, we just went back and sort of dusted them off and said, here's the basis for what we're doing, and that had been part and parcel to our lending guidelines, right? So we already had them available. It was really interesting. Again, I referenced the OFN webinar from last week with the folks in New York, and they basically said, yep, we already know what we're doing because we just did it in Sandy, and before that we did it in 9/11. So we know exactly what our lending product is going to look like. We know exactly how we're going to be dealing with this. We know exactly what our deferments are going to look like. And then, so yeah, I heartily endorse doing that. And then, as I've said, like the operational reserve, it just gives you a lot more space to operate. I mean, we're still doing things like managing cash on a 2-week basis right now, just to understand what it looks like and get a sense of it. But being able to have that sort of understanding that there's a little bit of operational cushion there, I think is helpful.
Yeah, and this last bullet refers to a program that Cameo runs called CDFI Essentials, and I bring it up because as Kat is talking about community visions, they have all the what I would call standard risk management things in place. They have risk rating that they do quarterly, which is rather admirable. They, have a strong loan loss reserve policy. They use the state guarantee program. If you're in a CDFI that doesn't have what I call these standard policy or program elements that are also mostly risk management elements, I really suggest you look at our CDFI Essentials program that starts on April 10th, because not only is it needed in an emergency time, these are things that are needed no matter what, and an emergency situation, if you don't have them in place, it's really important to get them in place. So we're happy to give you more information. These are some of the topics we cover. And a lot of it has to do with risk management and just being a strong program so that you can create economic impact and, as Kat says, remain viable as a community asset. And so we're talking about these emergency kind of what to do right now in the face of problems. But I think some organizations on this call maybe don't even have some of the standard risk management program elements in place. And so we really strongly encourage you to consider joining this program if you need to bone up on any of these types of things. And we're happy to give you more information about it.
Okay. And then I think we have like one more slide.
Just a couple more slides.
Yeah. Yep. So this is just, I'm sure you all know, right? This is such an evolving situation. It is unlikely you're going to just touch a borrower once and be like, okay, great, that's settled. That would be the case. We have said to our board when we did our sorting, we said, the first thing we need you to know is that the sorting is going to change, because whatever we tell you right now, a week or 2 or 3 from now, something's going to have changed and this is going to change. So again, communications and sort of managing expectations all around is helpful. Understanding that you are going to likely have multiple conversations, understanding that assuming the recession that we all assume is going to be here, that there's going to be both emergency, and then even when we're out of emergency, there will likely be recession. And so there may be what you did now, which is resiliency and response. And then there might be the, what is it going to be taking to take, the next however many months that there's recession, and be open and willing to have those conversations with your borrowers and revisit. The best thing we learned in the last recession was the way that we didn't have big losses and the way that we came out pretty unscathed was constant communication with our borrowers and trust building. Because if they felt like we weren't just calling to say, hey, how can we foreclose, but we were really calling about how can we problem solve together with you, they were open to those conversations. And sometimes it took a while, and maybe the restructures took multiple times, but we got through it. And then I think that this is the final point here. It's something I know we're all thinking about, is just, it's really scary. And we're talking about this in our leadership constantly. Like, what happens if someone becomes ill, whether that's a borrower, a client, or somebody on our own staff, and just, sort of being prepared and thinking about that. Internally thinking a little bit about redundancies in terms of, what you're doing, and just being able to be compassionate and responsive.
Yes, and I see there's a typo in the title. I'm going to clean up and add a few things to these slides before we send them out. There was a question in the chat about actually writing off loans that just look like even a deferment won't help them. And I think you could maybe address that really quickly, but I'm actually thinking that might be another webinar. Heidi asked that question. So I think that maybe in a month or 2, we should actually have a whole webinar on write-offs,
Yeah.
It's going to happen probably to everybody somewhere, right?
Yeah, I think that that's probably the right approach. I mean, if you really know that somebody's going out of business, then yes. And then, there's a whole kind of slew of things you need to be looking at about what if any collateral, and, is it worth liquidating, and what does that mean for your balance sheet, and, do you have the reserves for it, and kind of how do you allocate reserves? So, I mean, I think those are all things that you need to start thinking about, and, and then what are the kind of legal ramifications around what you're doing with the borrower. But it's complicated and not fun. So I do think that would be a good
separate webinar.
Yeah.
Okay, we'll tackle that unfortunate topic as we go.
Yeah.
So I know we've gone over our time, but I hope people have stayed around for some discussion. Is there any other? I think I've been checking chat. I didn't see any more questions. Does anyone want to unmute themselves and ask a question? Let's see. I think somebody just. So Heidi said, so the options are loan forgiveness, deferment, write-offs, anything else?
Well, let's see. Forgiveness, deferment. I mean, there's a lot of shades of gray in there. But yeah, I mean, there's forgiveness. There's on one end, if you have the capacity to do that and you choose to, and then forgiveness of interest or otherwise, right? That is truly up to your organization and your capacity to do it. But yeah, I mean, that's the possibility. If you think that that's one way where you're going to ultimately be able to preserve principal, then that makes sense. Then there's some combination of that. There's a negotiated settlement, right? Where there's something in between where you're forgiving some and not forgiving all. There's write-off, there's foreclosure. Yeah.
I mean, and there's even the idea that some people might need more capital to get back on their feet. So there's like probably endless permutations. I just went back to slide 6 here where we just talked about all kinds of different deferment structures with all, this isn't even an exhaustive list, right?
And may I just say on that, we've had one borrower, I won't get into the details around it, but they called us at first and like last week or a week and a half ago and said, we're not going to be able to pay you. Everything has just actually, all of our revenue has stopped. Can we talk? And then they called back and we're like, oh my gosh, we have an opportunity for pivoting, but we're actually going to need to get a little bit more capital in order to pivot. There we go. Right.
Yeah.
And so that conversation changed pretty quickly.
Yeah. Yeah, exactly.
Yeah.
So let me slide back down. I think there was one more chat question. Let me get to it here. Chat. How to tackle clients where you see there is sufficient business cash flow reserve for the business bank statement, but still requesting deferment for 3 to 6 months?
I think I would go into that conversation with an open mind, an openly skeptical mind, right? So what I think I would say is, give me besides, gosh, it's really scary, which yes, everybody, what's the reason? And if that's, we've got this cash, but our burn rate is equal to X, which means it's going to be gone in 3 months. Well, okay, that's a probably good reason to have the conversation. I would explore a little bit more. I certainly wouldn't just defer automatically. I would explore. And, I don't want to sound heartless. I understand that people are in really difficult times. This again gets back to that sort of balance of preserving your community asset of your organization as well as your borrowers. And so, and you can say that, right? I don't have any problem saying to folks when we're negotiating or talking, I'm not just trying to be your mean lender here. Let me kind of tell you what's our important priority and why. And so let's problem solve around this. Is this really a problem? Or is this more a security blanket? And then is there a way that we can negotiate around that?
Yeah, and some strong businesses are conservative around cash, and that's what makes them strong. So, I think there's a lot of ways to look at this, right?
Yeah.
And how thin can cash reserves get in a really uncertain time for people who like to manage cash conservatively, and that's been part of the strength of their business. So I think it is a complicated question and worth diving into.
Yeah, and one thing I'll say, we've received a couple of calls from some pretty well capitalized borrowers, and they haven't said we want to deferment, but they've said, hey, right now we're okay, but if this goes on for any length of time, we're probably going to want to check back with you. And that was actually a great strategy, because then we had an understanding that they aren't just automatically hitting the we don't want to pay you button. But they are saying, here's what we're planning to. And they are the ones that usually have a lot of cash management skills. And so I say that to say, sort of evaluate where the organization is coming from.
Yeah. So again, I don't think, oh, do we have more? I think we have another chat question. Anything else? I mean, I think, let's see, what time is it? It is 8:09. I just wanted to make sure we have this last slide, our resource page. Cameo has, it's just continually adding to its, coronavirus resource page. OFN has created a special community, a COVID community where I think there's documents and information. There's also just a chat on their CDFI Community Connect. There's several, I think, COVID-19 response chats. SBA has a website for COVID assistance. So I hope we gave you a lot of information. I thought this was really, as Heidi likes to say, chock-a-block full of good ideas and for you to work with. We are happy to send out the slide deck and the documents I showed you today. I'd like to thank Catherine Howard from Community Vision so much for jumping in and whipping this together with us and sharing your deep expertise having lived through the last recession.
All right, this is Heidi. I just want to say one last thing besides thank you to Catherine. Please be patient for the slides. It does take time to download, upload, all that kind of stuff. They will be sent out by Friday. We're just trying to produce quite a bit of content here for you so that our members can serve their communities. And I also want to send our thanks, Cameo thanks, to Susan and Catherine for just jumping right in. We're really grateful that our community is so giving and very willing to share their expertise. So thanks, and there's more. Check our website.
We're constantly throwing these webinars together.
Scroll down to the bottom, and the latest webinars will be there. On the homepage. Thanks everyone. Catherine, that was just really great.
Fantastic. And I hope to see some of you in CDFI Essentials. If you're looking at that list going, oh my gosh, how do I get started? We take them one at a time and do an hour talk on each one, and it'll really help you get launched if it's feeling overwhelming right now.
And I just popped my email into chat there so you can contact me.
Yes, if you want more information about CDFI Essentials, please get in touch.
Thanks, everybody.
Thank you. Thank you, Catherine, again. We appreciate you so much.
Yeah,
all right.
You're welcome.
Have a nice evening, everyone.
Stay well and safe, everybody.
That's right. That's right. Heidi and I can stay on for a minute just in case there's any last questions. Yes, mahalo. Thank you. Yeah, didn't you think that was good content, Heidi? I thought that came out.
I did,
good.
but